Hey, welcome back to Fintelliq. If you have ever wondered what actually happens to billions of dollars that pension funds, university endowments, and rich families offices invest, money that doesn't go into the stock market, then this video is for you. We are talking about private equity, venture capital. Two words get thrown around a lot, especially online, but that the most people don't actually understand. What do these firms really do with the money? Now, how do we make it grow? And why has the whole game changed in the last couple of years? By the end of this video, you will understand exactly how to private equity buys companies, how venture capital bets on startups, and why 2026 looks completely different from the pre-money years of the early 2020s. No jargon without explanation, I promise. Let's get into it. Before we zoom into the details, let's get out the big picture because that always makes the details easier to understand. Here's the situation. Interest rates have stayed high for a longer time than most expected. That's made borrowing money expensive again, and it's made the stock market feel a bit more shaky and unpredictable. So where has a lot of smart money gone instead? Into the private markets, private equity and venture capital. This used to be considered kind of a side bet, something only the ultra rich played with. Now they are a core piece of how big investors build their portfolios. And this is important, the old way of making money is in this space simply does not work anymore. The strategy that worked when borrowing money was basically free is now outdated. There's a new playbook, and that's what this whole video is about. Now let's talk about what actually changed in simple terms. Imagine you buy a house. A few years ago, mortgage rates are super low. So almost anyone buying real estate looks like a genius. Property values are rising and borrowing was cheap. That's basically what investing looked like in the zero rate years. Cheap debt made almost any deal look good. Now, borrowing costs a lot more, so you can't just ride a wave of cheap money and rising prices anymore. If you want to make a great return today, you have to actually make the underlying business better. You can't fake it with financial tricks. This is the biggest single mindset shift in the entire industry right now, and it's going to come up again and again in this video. So, okay, let's properly define private equity because most people have heard the term but could not explain it if you asked them. Private equity, or simply speaking PE, is when a firm raises a big pool of money from investors and uses it to buy entire companies, not just shares on the stock market. Actual ownership and control the business. Once they own it, they try to improve and eventually sells it more than they're paid. There are other flavors of this. First, large buyouts, buying big, well-known, mature companies. Second, mid-market deals, buying solid smaller companies that already make consistent money. Third, growth equity, putting money into a company that's already proven itself and just need to cash to expand faster. Different sizes, same basic idea. Buy it, improve it, and at last sell it. Now here's the part most people get wrong or fully understand how these buyouts are actually financed. It's actually a leveraged buyout or called the LBO, and the word leveraged is the key. Think of it like buying a rental property. You don't pay all cash, you put down some of the own money and borrow the rest from a bank. Then you use the rent from tenants to pay off that loan over time. A leveraged buyout works almost exactly the same way, except the property is an entire company and the rent is the cash the company generates from its own operations. Here's the twist for 2026. In the pre-money years, firms would borrow up to 70% or more of the purchase price because loans are so cheap now that loans cost much more, often 8 to 11% interest. Nobody can safely borrow that much anymore. Deals today are structured closer to 50-50, half money borrowed and half the firm's own cash. That one shift changes everything about how much return you can expect and how much these deals can get put together. So if you can't just pile on cheap debt anymore, how do private equity firms actually make money today? So this is the question. This is where it genuinely gets too much interesting, because it's not financial trickery anymore. It's real hands-on business improvement. The best firms now have entire internal teams of former operators, people who used to run tech companies, manage supply chains, or build AI systems, and they parachute these experts directly into the companies they buy. Their job is to make the business itself better and more profitable, not to rely on the market going up. There are two big tactics to stand up. One is digital transformation, literally modernizing outdated computers and using AI to bring down costs, especially the cost of getting new customers. The other is called buy and build. Buy and build is actually buying a company and then buying several smaller similar companies to bolt onto it, creating one bigger, stronger business. It also has a sneaky benefit, that is, it brings down the average price paid across all those smaller deals combined. Now let's make this super concrete with a simple before and after comparison. Before, I think this is the single clearest way to understand this shift. The old playbook states that mostly borrowed money, maybe 70 to 80% debt. Profits mainly came from paying a cheap price and later selling at a higher price, what's called the market expansion. And the main way firms crashed out was through big flashy stock market listings or selling to another giant company. And here's the new playbook, which means roughly half debt, half real equity investment. Profits now mainly come from actually growing the business and improving its margins. Real operational work, not financial games. And instead of splashy public listings, exists increasingly happen though what's called secondary burnouts, selling to another private equity firm or specialized structures that let a fund keep holding a great company longer instead of being forced to sell it too early. Now let's switch gears completely and let's talk about venture capital. The venture capital, because it plays a total different game than private equity. While private equity buys mature, already successful companies, venture capital does the opposite. It invests small amounts of money into brand new, unproven companies, hoping one of them becomes the next huge success story. Venture capitalists don't take the control of the company either. They usually just take a minority slice, a percentage ownership, while the founders stay in charge. After a wild few years of extremely high valuations for startups, the venture world has matured and became a lot more disciplined. It basically splits into two stages. early stage investing, which is about backing a founder's vision before there's much proof it will work, and late stage investing, which is much more selective and now demands real evidence a company can grow efficiency, not just work fast while burning cash. So here's exactly is the venture money flowing in 2026. There are three areas to stand out clearly. First, applied AI. You must have heard about it, and if you have not heard, then let me discuss it first. You have moved past the phase of just building giant general AI purpose models. Now the money is going into specific practical applications of AI for practical industries, plus the infrastructure needed to run AI closer to where it's actually used, like on devices instead of giant remote data centers. And second, deep tech and advanced hardware. This includes defense technology, private space and aerospace companies, quantum computing, and building secure supply chains for computer chips. And there's the third, climate technology. Yes, climate technology, real practical solutions like better energy storage and stronger, more resilient power grids, not just concepts on a whiteboard. These are the areas where a huge share of venture capital's best opportunities are concentrated right now. And let's put private equity and venture capital directly side by side, because up to now we have looked at them separately, but comparing them really locks in the difference. Private equity invests are in mature, already profitable companies. It usually takes full or majority control. The risk of the whole thing failing is relatively low to moderate, because you are buying something that already works. The value is backed by real, tangible business assets, and the returns are fairly steady and predictable, typically aiming for 15 to 20% annual growth. And here's the venture capital. It's the quite opposite is almost every way. It invests in brand new, unproven companies. It only takes a minority stake, letting founders keep control. The risk that any single investment completely fails is actually quite high. Most startups don't make it. The value is mostly based on an idea and the future potential rather than physical assets. But when it works, the payoff can be enormous. Funds often aim for 3 to 5 times their money back or more, because a few big wins have to make up for all the failures. Here's a concept that trips up almost everyone new to this space. It's called the J curve. Here in the screen you can see the J curve in the graph. Once you understand it, a lot of confusing behavior in these funds suddenly make this sense. Picture the shape of the letter J in the few first years of one of these funds. The reported value actually goes down, not up. And why? Because the fund is paying fees upfront, covering transaction costs, and some early investments have not proven themselves yet. So they get written down on paper. It generally looks like the fund is losing money in year 1, 2 and even 3. But then, as portfolio companies mature and even get sold for a profit, the curve swings sharply upward. That's the tail of the J. This is exactly why these investments demand serious patience, and why smart investors always keep other cash on hand, because the fund will keep asking for more money in those early years, or even while it looks like it's underperforming. Now here you can see, so if you are a professional investor deciding whether to trust your money with one of these big funds, what would actually check before writing a check? So there are 3 big things. First, speaking with, Where did their past success really come from? That's the big question. Did the manager genuinely improve business, those skills, or did it simply get lucky riding a rising market that won't repeat? Second, this is how is the profit sharing structured internally? If only the top 1 or 2 people at the firm get rewarded, the younger talent tends to leave halfway through the 10-year life of the fund. So which is that's a red flag you can see. And the third one are they honest about how they value their own investments? Some funds are actually tempted to mark up the paper value of unsold companies to make their performance look better than it really is. Real due diligence checks for that kind of self-serving accounting. And let's bring everything together now. The line between public markets like the regular stock market and these private markets is getting blurrier every year, and both private equity and venture capital remains powerful tools for building real wealth. But this is the big but that holds true if investors trade blind optimism for real discipline. The easy money era is actually over nowadays. Success today comes from picking managers who genuinely know their industry inside and out, staying rational and grounded about early stage tech bets instead of getting swept up in hype, and making sure the people managing the money have their own incentives lined up with yours as the investor. That's really the entire story where private markets stand up right now, and it's a mindset shift. Yeah, it's a mindset shift worth remembering the next time you hear a flashy headline about some huge private equity deal or a startup sky high valuation. So, and that's a wrap on this deep dive. If this helped things click for you, do me a quick favor and hit the subscribe button. It genuinely helps this channel grow and it costs you nothing. Yeah, drop a comment and let me know. Would you rather have the steady, predictable return of private equity, or would you take the big swing for the fancy risks of venture capital? I am curious to hear where people land. Thanks for so much for watching all the way though. I have got more breakdowns on private markets, macro strategy, and how institutional investors actually think coming very soon. So stick around, see you in the next one. Till then, bye.